The chefs out back cooked up a beautiful CPI inflation read this morning, beating the expectations on all counts. Jerome Powell then proceeded to give us an absolutely worthless report at 2 o'clock for the FOMC. And if you actually believe what he said and the committee projected, then the market should be trading somewhere back down towards 4,800. Obviously, we closed at new all-time highs today. Welcome to the Trade Brigade Midweek Market Update. My name is Matt, and I want to show you where that 4,800 number is coming from, more importantly, why I don't think we're going there, and we should probably talk about Apple while we're at it. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, and stay tuned until the end of today's show. I've got 2.5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off with a closer look at the SPY daily time frame chart. Of course, the trend here remains in the upward direction with a massive higher low over the 50 SMA, and we had highs, higher highs, higher highs, and we've just produced brand new higher highs. So this means that the daily time frame chart can afford a pullback to search for some sort of higher low without jeopardizing the current uptrend that we've just described. If the market were to pull back, there are two really obvious areas of potential support that I would watch for. A gap fill reversal over the highs of the Tuesday session is location number 1. That level is at 537. Anything that's deeper than that, I would really look to this daily zone here between 533 and 531.40 for a daily higher low and continuation in the upward direction. This zone is now my new daily line in the sand. I would no longer use 528.40, seeing that we've clearly broken out of this as a balance range and this as a balance range. We really don't want to have two areas of potential overhead supply. So if we were to fall underneath this, now you have overhead supply number 1. Therefore, we don't really want to use this as a line in the sand, right? You'd be underneath already this previous area of balance. It would also just be a very clean test of this previous all-time high via the bearish engulfer open. And, if we were to test these lows one more time, some repair of all those very equal interaction points on the daily time frame would not be unreasonable. So, daily line in the sand is now known over here, and a gap fill reversal would be more optimistic. Is it reasonable that a pullback could unfold here? I think the answer is yes, noting that on today's session, we've produced a bearish inverted hammer at the highest high in the trend count, sort of rejecting the upper edge of the weekly expected move as well. I have more internals data to share with you in just a moment that'll also support that a pullback would not be unreasonable. I would be concerned if the daily time frame chart started to trade in here. I would flip my bias to neutral underneath that key line in the sand zone we were just describing, and then bearish if we were to take out 528.40, noting once again, we would have two areas of overhead supply weighing on price in the downward direction. Let's quickly go out to the weekly time frame chart because we were talking about 480 in the intro, and I do want to point out that 480 or 4,800 over in the SPX index, right, would be way down here at the weekly 50 SMA. You'd likely fall into a weekly downtrend before you got anywhere close to that area, and that's just currently not what we have on the higher time frame charts. If we bring it back down to the daily time frame chart, you'll also notice that 480 is your daily 200 SMA. So, regardless of Jerome Powell's comments, I don't think we're going here into the end of this week. Of course, we would flip into a daily downtrend well before we would start forecasting that 480 is a possible area of importance. Let's take it on down to the hourly time frame chart, and there are also fundamental reasons for 4,800. Like, that's not the only take for 4,800, so stick with me until the fundamental component of today's video. But on the hourly time frame chart, let's begin with, really the early stages of Monday and Tuesday in here. Remember, headed into the week, we were talking about the possibility of some sort of head and shoulders to emerge, something that looked like this, right? So on Monday, notice that we actually did not respect the key Thursday high of last week, which is at 535. We closed above that level. So your right shoulder was not at the ideal location, number 1. On Tuesday, you ended up opening underneath this sort of overhead supply, if you will, that afternoon consolidation from Monday. So let's put ourselves in the shoes of sellers on Tuesday morning, right? We flush underneath this area. Technically, this is still a lower high. It's not at ideal location, but it's still a lower high. You flush underneath 533, and is there any follow through in the downward direction via some sort of hourly lower high underneath? The answer is absolutely not. So as we continue to ask ourselves the question, do we have stronger sellers getting involved in this market? The answer to that one is no. And we can also ask, who's being rewarded in this market, and it's been this way since the Friday session of 2 weeks ago, dip buyers, dip buyers, dip buyers, dip buyers on the gap fill reversal, and dip buyers here for what we can now see as a look below and fail, right? As soon as we got the Brigade Bolt right back up over the opening print, it was off to the races targeting the equal high to the Friday session of last week. So no stronger sellers, dip buyers continue to get rewarded. As we walk forward to today's session, obviously huge gap up on the CPI prints, beating the expectations there. And we'll ask ourselves the same question. If stronger sellers are going to get involved, if we're going to trap the overnight inventory as overhead supply, you'd tend to think that the gap can fade fairly quickly, and that obviously did not take place. There's an opening drive to the upside, and only once Jerome Powell leaves the stage do we start to test those lows and, even close ever so slightly underneath the opening print. There wasn't much acceleration underneath that low of day to close the gap beneath us, so again, not really seeing much evidence of stronger momentum-driven sellers pushing this market in the downward direction. One really interesting nuance, though, as we zoom in here on the hourly time frame chart, I'm even going to bring this up like this, is notice that on the FOMC volatility, we took out the high of day, and there's absolutely zero acceptance over that high. So I'm not thrilled about new money buyers late to the party executing at these higher highs. But again, just in terms of the sell side pressure, we're also not seeing anything substantial. So I would lean back on the idea that any sort of breakdown lower high here can close the gap. That's fine. But once we get to the gap fill reversal, I'm thinking about hourly double bottoms, I'm thinking about inverted head and shoulders, I'm thinking about hammer candles down here, any signs of reversal over that 537. If we don't get a lower high underneath the low of today's session at 540.32 and it's just consolidation up here, I would say be on the lookout for your next balance range to ultimately form and some sort of catalyst or a clean, simple price action break to get us out of it in the upward direction, or this still stands as a possible fade in the downward direction, right? If you're looking for a short, your risk reward is ideally something that looks like this, and we're not overstaying our welcome at these potential targets. So that's number one, and the upside obviously takes care of itself. If there's a break and a higher low over today's high of day loosely, let's just call that 544, you're looking at blue sky territories, whole and half dollars, intraday levels that form, right? That again, upside always takes care of itself in blue sky territories. If the stronger short is going to get us down into this daily higher low zone that we were just talking about, you're probably looking at a pretty rapid tempo move to get us here, and then consolidation extremely weak on the lows that's not really finding that strong dip buy reaction off of 537. If you notice that markets stagnate and are really, really stale down here and slow at 537 and the internals are pretty lackluster, I would not be overly aggressive looking for the dip buy there if there is no structural setup via, again, the double bottom, inverted head and shoulders, or very simple hourly hammer bar, right? So then the next breakdown would just be simply, if this turns into like bear flag or consolidation congestion near these highs, a break there, it's just rinse and repeat, and you're ultimately looking for this. And now on the daily chart, I would keep an eye out for daily hammers down here and that stronger interaction for the higher low that we were just describing on the other time frame. Let's take a look at some Fibonacci's off of the low from the failed breakdown, the look below and fail on Tuesday. If I do something that looks like this, notice the 61.8 is the gap fill reversal, reinforcing that level. Remember that if you can hold up over a 61.8, that's the line in the sand. If we're underneath a 61.8, generally speaking, a 100% retracement is definitely in the cards, right? So the odds of that retracement would increase underneath 537. If we bring out the anchored view apps from an intraday perspective, what else can we learn? You are going to get confluence over time as this slowly drifts in the upward direction with 537 reinforcing that idea. And again, over time, we're not expecting a huge opening drive to the downside, big liquidation break. I'm not seeing that type of evidence. So I would tend to think that as the week wears on, right, and as price is trying to resolve these levels in the post market, you can even see we're higher, 542.11 by 12, so somewhere up here, right? These will slowly continue to drift, and once again, where's that key zone on the daily? It's right around 533 and 531.40 as the ultimate line in the sand. So I like the pullback levels in terms of confluence. Let's move on over to the market internals now. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. And what I want to talk about is the move on Tuesday, right? Because Tuesday is where that look below and fail happens. The Brigade Bolt is ultimately in play there. But what were the internals actually doing? We had volume outflows. We had the advanced decline line squarely under the zero line all day. the index score was hardly positive into the afternoon as we're breaking to that new high of day, right? And if you look at the cumulative tick, it's also, I don't want to say firmly negative, but it's definitely red on that Tuesday session, right? So this is where we have to start evaluating, or at least considering, the concentration risk out of something like Apple. The one stock to rule them all now is not so much Nvidia, it's actually shifting back to Apple, which was for the longest time, right, the one stock in the market that you never, ever bet against. So Apple rallying to the upside, of course, caused a lot of that resiliency on the Tuesday session. If Apple starts to pull back more aggressively, I would factor that into the analysis here as well, noting that at the exchange level on Tuesday, you really didn't have much volume participation, advanced decline line participation, or even the tick participation, intraday there. As we're evaluating today's FOMC move on the gap up from CPI, I mean, better, absolutely better there, but certainly fading into the afternoon out of the advanced decline line. I will say that the index score is much more sort of positive for the market here, as it's printing these moves in the morning session, at least 13 and 15. Remember, the score is out of 25. That's pretty substantial. The volume flow is not great, so let's make concessions where concessions need to be made. I mean, we're not even close to strong volume inflows on the move to the upward direction. So what this would start to tell me is that, sure, it was a euphoric move on the CPI print there, but in terms of new money longs wanting to commit volume up here, a little bit lackluster. And I believe that this ties in directly with sort of the pullback thesis we've just described over here in the S&P cash. If you get something that looks like this, longs are either taking profit up here or don't want to commit new volume. I would look for the internals to strengthen as in if we're starting to retest some of these key pullback levels that we were just describing. Let's take a look on over at the market profile now, because this is really interesting. You'll notice that there's a double distribution on Tuesday session, upper distribution and lower distribution here, separated by a very, very small string of J period single prints, and the value area and point of control from Tuesday is actually situated in the lower distribution. So what would that start to suggest? That any of the dip buyers are still holding from really great location. It's not like as soon as we test the high of Tuesday's session, which is basically the gap fill, right? 537 we just saw over in the SPY cash. It's not like as soon as we test that, these buyers are going to be like, oh my goodness, should we start to close out positions? Not the case at all. Another interesting takeaway here is that there's actually no volume commitment at price in a segment of the overnight range here. And this is when the CPI was released at 8:30 on the spot. As the market sort of, made this move to the upside, there's no volume commitment. Like, I can zoom way in on this so you can actually see the number of contracts at price. It stops here at 8:30 when the number is released at 53.95. And if we look through the overnight range, the next print only shows up here, which is at 54.17. And what's interesting about 54.17 is that this is loosely the low of day from today's session. So as we truly break down underneath today's lows, if we break down underneath today's lows, you're moving into a zone that quite literally has zero volume commitment at price. The full gap close is about 10 points beneath where that volume starts to cut out at technically 53.85. And as we just saw in the ES futures, the SPY cash, 537. The value area is sort of central on today's session, and we do have a lack of material excess at the highs, which is not much of a surprise considering that failed break we just talked about on the hourly bar, where during the 2 o'clock FOMC, we made a new high of day tick, but did not find any acceptance up there. So carrying forward that this is a poor high, in my view, is actually a bit more of a bullish indication, signifying that it wouldn't be unreasonable for the market to test this high of day. If we test it, I would expect a break, and then your next big piece of information is whether or not we put in an excess high and then come back down into today's Wednesday range. If we do, the excess high can stand as the all-time high, the proper end of the auction. I would look for the gap to close on a big rejection there, right? Acceptance and value that remains inside of the Wednesday session. So if Thursday's value is here, but the high of day technically breaches for a new all-time high, pretty big indication that there's a lack of acceptance. And once again, we saw this on the market internals. There's not much volume commitment up here at these prices at the exchange level, right? So once again, the target to the downside is the gap close, and we'll see whether or not dip buyers can step up here. I do want to give you the single prints just because, again, if we are above in distribution number 1, I would still make the argument that the buyers are more so in control. That's 53.70 out of your ES futures. And if we go back on over to the SPY cash, you guys should be familiar with this level as well. It's actually right here at 535, which originally could have been the possible area for the right shoulders out of the head and shoulders. Simply never took place. As long as we're above that, you're still technically in control of the buyers on the higher time frame charts. Changing gears to the QQQ Nasdaq 100 on the daily time frame chart, there's a lot of overlap here with our S&P 500. Of course, we have lows, higher lows, big time higher lows, highs, higher highs, and of course, a brand new all-time high. Just like the S&P, we can afford a higher low pullback on the daily time frame chart without jeopardizing our uptrend that we've just described. A difference here is that clearly it's not as much of an inverted hammer near the upper edge of the weekly expected move. You've got much more of a green body on the daily bar out of the Nasdaq and equal size body in terms of the upper wick instead of the discrepancy like we saw over in the S&P. So not as bearish here in terms of that afternoon breakdown. I would still make very similar arguments about daily pullback levels. If we were to pull back, a gap fill reversal is incredibly constructive, finding buyers over the Tuesday high here at 468. If we were to go beyond that, I could also see the 3-day range here, the highs of that acting as support at 465. Anything that looks like this is also constructive in the upward direction. And on the Nasdaq daily time frame chart, I would go out on a limb and really say something like all the way back down to here at 459.25 is still a reasonable daily higher low for continuation in the upward direction. Obviously, any consolidation inside of this range is just bullish inherently. Any breaks and higher lows, and we could probably be on the hourly chart for this, but breaks and higher lows outside of today's range, obviously bullish, looking for those blue sky territories. Let's take it on down to the hourly time frame chart, see what else we can learn. Once again, you did not get as aggressive of an afternoon breakdown from the QQQ Nasdaq. However, you did get a similar indication where you breached the morning high and did not find buy-side acceptance over that at your new high of day. And we'll see this on the market profile is actually looking like really solid excess instead of a poor high like what we had over in the ES futures. So very straightforward, no need to complicate things. Obviously, this is your downside trade, lower high here. You're trading from point A to point B and then reevaluating. If the market goes beyond that, right, we just talked about how on the daily time frame chart, we have 465 in here, the top end of the multi-day range, which broke out here. So first order of business is that this is reasonable, then it's double bottom, it's inverted head and shoulders. It is, of course, your hourly hammer candle. Trading back into the equal high would be the anticipated target there after setting a daily higher low. If we continue beyond that, take all of these same setups, double bottom, inverted head and shoulders, hammer candle, and stack them right here at the 465. We're all good. Everybody understands this perspective. We are good for those two key daily higher lows. If we were to get inside of this balance range here, that's where I think that stronger shorts can possibly unfold, because we do have to remember that there's thin structure back here. I mean, there's definitely an opportunity for some sort of short that if it really unfolds like this and we're consolidating, there's a break here, I think that this starts to become slightly more dangerous, obviously on the hourly time frame chart first, but even on the daily. Unless you really find a sharp reaction from the buy side off of that 459.25 we were just describing, anything that's like pretty weak in there, anything that looks like this, and consolidation down here starts to become somewhat concerning. Like, why was there this, what would appear like in hindsight, a blow off top near the highs, and now suddenly we're consolidating underneath this? That wouldn't really make sense if you're trying to be constructive and looking for a continuation play in the upward direction. You'll also notice here on the Tuesday session, as we just rewind the script just a hair, I mean, you didn't even set a new low. You didn't sweep any of the bottom of this balance range here on the Tuesday session. You did not make a new low underneath Monday's low. So a bit more healthy, and the breakout into the afternoon was very, very straightforward. You had all of these equal highs, 1, 2, 3, like all of them. I'm not going to count them all, but you get it, right? Really strong breakout there. So still on the side of buyers being in control of the Nasdaq. We know that there's that strength out of Apple. Even Nvidia today breaking to new all-time highs. I mean, the tech sector right now is absolutely on fire. So I think you'd be a little bit misplaced to start having a bearish sentiment here without some sort of stronger reversal in trend. If we bring out the same Fibonacci, we can come in from the Tuesday low just because it represented sort of a dip and go, a dip and rip, if you will. 61.8 is still confluence with your gap fill reversal. 468 is the level there. And we can briefly check in on our intraday anchored VWAPs as well. Maybe over time, these start to coincide with this. I wouldn't really argue that this is a strong one here out in terms of confluence, at least out of the Nasdaq, until we're actually at this level. That might take until Friday at least. So consolidation up here certainly will allow that to be dragged in the upward direction, but it's probably not in play for tomorrow. If there is a larger breakdown into the end of the week, I would tend to think that these can start to align more so with some band of support around 459.25, which once again is our daily line in the sand that we were just describing. Here we go with the Nasdaq internals. You can clearly see on Tuesday with that follow through move, we still had lackluster breadth. the advanced decline line was negative, the cumulative tick was also negative. If you look at what's happening on today's session with the big CPI gap up and then really just holding sideways through a duration of the afternoon, I would call it a balanced session there. You did see strong volume inflows to the NASDAQ side of the market. The advanced decline line was near trend higher zone, definitely fading lower, but near trend higher zone. But we didn't really have much of a solid cumulative tick in the upward direction. So once again, as I add all of this up, it looks like, if anything, there's more of an opportunity for trapped longs to be up here based on the volume flow. So the commitment at these highs seems to be a little bit more so than the S&P, but the actual ticks at the exchange level were not really upticks for a duration of today's session. Notice how compressed they are in here, and even on the FOMC getting a little bit more negative. So if you're looking for a gap to fill, even though the daily time frame chart looks a little bit more constructive than what we just saw over in the S&P 500, based on the volume flows, based on the amount of positions held here at the exchange level, like across the tech sector, if you will, it might be easier to turn this into overhead supply compared to what we have over in the S&P 500. Just a thought, not something cemented in stone, and obviously both setups require the hourly lower high underneath the low of today's session anyhow. If we're thinking about the market profile out of the nasty NASDAQ, what do we see here? Certainly, really, really compressed value area, point of control, prominent TPOs here, really as a normal curve, looking like a bell distribution. Great excess at the lows, great excess at the highs. If we open inside of range here, it wouldn't be a shocker that this could potentially hold as a euphoric high, the proper end of the auction. We do still have the double distribution from the Tuesday session, just like the S&Ps. And obviously what we can see here is that just extending this off to the left, it is your multi-day range highs. So back on over to, I'll give you the NASDAQ number first, actually. That's 19,175 out of the NASDAQ. As long as we're over that, we're bullish, right? You could go for the gap close, but as long as you're over that, you're bullish. And if we go back on over to the QQQ cash, of course, that's just this level right here, 465, that we had already described in detail. The Rusty Russell is up next. IWM Russell 2000 small caps on the daily time frame chart. Obviously, one of these things is not like the other. First of all, there is no all-time high here, obviously, and the trend is very convoluted. I would say at best in this box here on the daily, it's even worse than that. We can zoom out a little bit further. In this box here on the daily time frame chart, we do not have a trend. I mean, maybe you have lows, maybe higher lows, but you also have highs, lower highs technically, lower highs, equal highs. Lack of trend, more so a massive daily balance area here. The most constructive thing we could possibly say about the small caps is how on the Monday and Tuesday session, based on the gap down Monday and the open Tuesday in range, we looked underneath Monday's low. It was a big old test of the weekly line in the sand at 200. And for those of you who are unfamiliar with the level, here we are on a weekly time frame chart. Remember, it's the top end of this massive area of weekly, monthly, even yearly balance underneath us. So continuing to hold up over 200 is really key out of the daily time frame chart. Unfortunately, out of the CPI gap up, you'll notice that we were unable to breach this set of highs back here, and we've also faded off aggressively underneath the opening print, not closing all of the gap, but at least 50% of the gap. So if this market were going to be more constructive in the upward direction, if we were really going to be bulls on parade, oh my goodness, the small caps, they're going to act as a huge tailwind for the S&Ps. Ideally, this just would have consolidated near these highs and set up the breakout for something over this flat top area of resistance into the end of this week or perhaps even early next week. That's not what we have currently. It doesn't mean it can't happen into the end of this week, but noting sort of the rejection of the top of the balance range here, closing back down in the midpoint of this balance range. Obviously, this is very sensitive to economic data, and what Jerome Powell said was not helpful, really, which was hence the whole component in the intro there talking about 4,800 over in the S&Ps. I mean, small caps are showing us that if they take Jerome Powell's word at face value, I mean, operating conditions are not going to get easier anytime soon. A 25 basis point rate cut is not going to do much. And at this point, the SEP only outlines one of those into the end of 2024. So that's sort of why the wind got taken out of the small cap sales here. I would say that maybe we could remain somewhat neutral if we can hold up over 203.25. It's not just sort of where we wound up at the low of today's session. It's multiple low, highs first of all, and then lows, 2, 3, 4 in here, 5 in the upper wick of that bar, a very structurally relevant area at 203.25. If we're consolidating in here, maybe I would remain neutral. If we really start to fade the gap a little bit more and come back down into that 200 level, I would be really concerned into the end of this week. Why? Because first of all, on the daily time frame chart, this is a failed move towards the top end of the range, but more so on a weekly time frame chart, you'd be right back down at what could be considered the neckline of a big old head and shoulders, something that would look like this. If we're at 200 and if that starts to break down, kiss this thing goodbye on the higher time frame charts. You really start to experience some danger from a headwind perspective across the broad market as we're trying to evaluate whether or not, the broad market rally is truly broadening out. If small caps are not going to participate, if they're going to be back down here at 200, obviously that's a little bit of an issue. Let's take a look at the hourly time frame chart to be a little bit more granular and sort of evaluate what's happening. So again, night and day difference with the intraday charts, a little bit of an opening drive to the upside, completely wiped away on the FOMC, not only announcement and the SEP, but Jerome Powell's commentary as well. So you can see all of the interactions we've talked about in the past. You're either going to support here and will remain neutral. I would remain somewhat optimistic for your S&P, and I'd still be looking out for dip buy opportunities if the small caps are inside of this range. If the small caps are going to pressure the bottom end and come into 202, it would really have to be a sharp reaction off of that and staying far away from 200. If small caps are below 202, the bottom end of this, correct, something that looks like this, then I would start thinking about, okay, we probably need to dial back expectations of what the S&P 500 can ultimately do. If we come in from the Tuesday low with the Fibonacci's, not to like sort of evaluate, okay, look at this big run, like where are we at, just to sort of say like where are we in terms of the overall range that's been trading recently, we're not holding up cleanly over the 38.2. 61.8 is right there at that line in the sand we were just describing at 202 flat. So if we're over that, maybe holding on to hope in here. If we're under that, I would tend to be a little bit more pessimistic for the broad market as a whole. Let's bring out the intraday anchored view app, see what this is telling us. We're at the cluster. It's do or die here, 203.25, 202. Both of those levels sort of need to do something ASAP, and if they don't, I would be more concerned once again for the S&P 500 as a whole. So this stacks up as a little bit more of a bearish data point so far, considering that the S&P and the NASDAQ in isolation are much more bullish just on their own, right? If we take a look at the internals for the small cap side of things, nothing substantial in terms of volume inflows on today's session, even though the gap up, it was a partial gap close. I would say that sellers didn't do their job all the way in terms of closing the gap. The advanced decline line rotates lower, and you can see we actually have a little bit more of a meaningful negative build out of the cumulative down here as well. On the Tuesday session, as we recovered off of that weekly line in the sand test, what did we get out of the internals? Kind of a scratch day, not much going on there. The volume flows are completely flat, and we were trying to work our way off of the trend lower zone, but we were still firmly negative through the duration of that session. Let's take it on over to the market profile for the Russell side of things. The value area is certainly higher in the individual profile. I would argue skewed towards the upper 50% more so than the lower 50%. So if we're opening under value and we start testing the top end of that gap, it would seem to me that overhead supply could easily cause the continuation of the gap close and a big test that we were just describing on the IWM cash ETF around that 202 level. Here on the Rusty Russell futures, the gap closes down at 2032.50. 2032.50. If you're over that level, maybe you've got a saving grace. If you're inside of today's range at this point, then maybe you've got a saving grace to stay neutral. If you really start falling underneath that 2032.50, I would start thinking about stronger headwinds for the S&P as an index. Let's continue to provide some context for our market here by evaluating the weekly performance of the S&P sectors. Leading the pack is the semiconductors ETF, up 4.77% on the week thus far. It's not technically an S&P sector, but it does have a lot of influence over tech, right? And of course, it's more of a risk-on indication, so I like seeing that leading as the market's gapping up to new all-time highs. Just underneath, we do have an S&P sector. It's the XLK tech sector, almost mirroring the SMH, up 4.73% on the week. Heaviest weight risk on sector checks out at the all-time high. Something that is slightly concerning that's going to start coming into the narrative, maybe a little bit more so here, is the fact that on a weekly basis, the TLT is outperforming the S&Ps by over 10 basis points. Now, it's not like, oh my goodness, duck and cover, run for the hills, button things up, this is going to turn into this big risk-off environment for the market, but it's something to keep an eye on. If the TLT bond sort of ETF really starts outperforming the S&Ps as we're hanging out near all-time highs, I would mark that down as a bearish divergence. So we're starting to pay attention. At the bottom end of the barrel, it's going to be the XLP consumer staples. As we know, it's a lightweight risk-off sector, so this checks out as the market's making that new all-time high. Next up, we have financials. This does not check out, right? This is technically the second heaviest weight sector. It's definitely more risk on. Not ideal to see this weakness in financials, down 1.19% on the week. Beyond that, it's energy, lighter weight sector, not as concerned out of that. So let's check in on the structural charts and just evaluate what's happening. I mean, the SMH, it's just bulls on parade. It's very difficult to say anything bearish about this chart. You could go gap fill reversal here. You could go gap fill reversal here. You could even, I would argue at this point, go weekly higher low over the big breakout point at 237. You've already got a daily retest, but a weekly could be reasonable at that zone. Don't get me wrong. A pullback, of course, is intra-week bearish pressure for the S&P, but structurally, the chart looks fine and bullish. Let's take a look at the XLK. Very similar comments over here, gapping up to new all-time highs. This is no longer divergent. Remember, last week, the broad market SPY made a new all-time high, whereas the XLK ETF did not. So that has been sort of fixed, if you will, if you want to call it that, repaired on today's session, even on the Tuesday session, breaking out there, of course, due to Apple. So really liking what we're seeing out of this. This is another bullish indication. We can check in on the XLY. I like the improvement over here. Remember that this balance range has really been a headache for us over the last couple of weeks as the market broke down away from it. The big threat was a massive lower high underneath. So we did the dance there for a little while. It was looking a little bit scary on Tuesday, I must admit, with that low underneath the 3-day balance lows breaking the 50 SMA. But on today's session, with the gap up recovery of that high of the balance range, I would start to change my tone and say, okay, this is a more meaningful reaction. We are no longer underneath the neckline of this as a double top. We're no longer underneath the bottom of this as overhead supply. Can we just at best, can we just consolidate and not at least be an issue for the S&P 500? That would certainly be helpful. If the market's going to see more of a rotation, meaning that the tech sector is going to pull back, you probably want continued outperformance into the equal highs out of your XLY. Leaves a little bit to be desired, noting today's candle structure as an inverted hammer. Next up is real estate. Really not much to talk about here. We are back over this key inflection point. It's a lightweight sector. I'm more concerned when we make new swing highs or swing lows. At this point, neutral. It's such a lightweight sector. We're moving on. XLI also hasn't really been doing much. This is much heavier weight. This is about 8% of the S&P, but not much going on here in the midpoint of that balance range. Materials, similar commentary. It has not made a new swing high or a swing low in quite some time. So neutral until proven otherwise. It did not hold its gap up this morning. It faded all of the gap, and I would argue if we test these lows, I wouldn't be surprised to see a new swing low produced underneath 88.65. So small headwind for the market, but nothing that's oh my goodness, duck and cover. More concerned if the weekly ends up resolving as a massive double top, lower high double top at that, with some sort of acceptance underneath. We're not there yet, but it's something to be thinking about. Communications on the flip side of the coin look great. We were talking about this breakout over here. It's really acted as a tailwind for the S&P 500, furthering the bullish pressure. I will point out that we did not hold the gap up this morning. There was no gap and go, but I do like the fact that this is either simply bull flag consolidation that's taking place, or even better than that, show me a sweep of these lows, test for a daily higher low over the breakout point here at 82.90. That would be beautiful structure, right? You've just got these simple stair steps in the upward direction, looking for the trend to continue for bullish pressure in the market. Next up, we've got utilities. I like the weakness just in terms of the laggard effect. We know that it massively outperformed back here. So as the market's breaking to new all-time highs, love to see it cooling off. The rotation is making sense out of Utes. If we look at the XLP, down aggressively today, same concept here. This is a D for defensive sector. It's not underneath the neckline yet. Don't get me wrong. Downward pressure is downward pressure. We don't want these things falling off of a cliff, but the chart really doesn't look all that bad, right? You could still technically argue you've got these consecutive series of higher lows. I mean, if you even just held the 50 SMA, that's a very nuanced but technical higher low. So 76.25 as we come barreling into it, is that going to act as support? We'll see. If it does, again, your S&P is probably not going to fall off of a cliff. That requires everything firing in the downward direction. So financials, speaking of things that are of concern, we were really tangled up at the 50 SMA, and it looks like it's trying to resolve in the downward direction. I'm not fond of this for the biggest reason just being that this as a head and shoulders, if it breaks down, if we really start to break down underneath this level here at 40.45, that's going to be a big deal for your S&P regardless of what the XLK is doing as a whole, simply noting that this is the second heaviest weighted sector by market cap. It's also more risk on in nature, so I would dial back my sort of expectations of continuation, and I would make the argument that concentration risk becomes even more sort of magnified in the S&Ps if financials are not participating in this break to the upside. If you have a diverse set of sectors breaking out, pushing markets to new all-time highs, great. Tech can pull back as financials continue to outperform. Because that's not the case right now, because we're nowhere near this swing high. That's actually the all-time high out of the XLF. Again, a little bit more reserved here when it comes to analyzing financials and its impact for the S&P as a whole. Energy, lightweight sector, we know that it's been stair-stepping lower. We know that this is technically good for inflation. We actually saw that really dramatic, impact on the CPI print this morning. We'll get to that in just a moment. And here is the XLV, third heaviest weight sector by market cap. This is okay. This actually keeps bulls and bears happy, noting that although it's the third heaviest weight, it is technically D for defensive. So sideways up here, it's not totally risk off, but it's not totally risk on either if this has to be the sector to break us and continue into new all-time highs. Let's jump on over to the ratio grid. Apologize as I load this up here. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner on how to set it up. So obviously massive outperformance from the tech sector as Apple just rips to new all-time highs, up 7% on Tuesday, and on today's session stacking on another, let's just round up there and call it 3% for an even 10% over the span of 2 days. Just absolutely incredible. So this is a risk-on indication. But if it pulls back, this is where your red flag starts to emerge, right? Financials dramatically underperforming. So unless there's a clear rotation, this is sort of I don't want to call it a recipe for disaster. I don't want to be too doom and gloom, but posture-wise, financials, they're the burden on the market as of right now. This is not an issue. It would be great if the XLY could finally get in gear and actually do something in the upward direction. We know for a while it has not been a helping force for the market. This eliminates some of the fear of risk off, as does this here out of utility. So I'm not also seeing like, oh my goodness, duck and cover. It's really just that those financials are not helping out, if you will. Massive risk on indication here. Let's continue through some of these specialized ratios. Massive risk on indication here. There's the possibility of a pullback off of that level, but generally speaking, as the market's breaking new all-time highs, liking the improvement off of the lows here. Let's take a look at apples to apples. Again, improvement off of the lows. It would be better if it was printing new all-time highs, but, well, one step at a time. It is a risk-on indication currently. Let's move along to this one. Again, big risk-on indication over here. As we move along to the dollar, this faded off the top end of the major balance range. If we were to go to like a weekly time frame chart, you can see this. So the 105.65 level is really what we care about originally from way back here, here, and here. Acted as support, resistance on the breakdown, so on and so forth. We're actually breaking down from that on today's session. So I would argue that this is helpful to try to set some sort of weekly lower high. If that's the case, equal low breakdowns. If the dollar is going to continue to move lower, that would support the bullish thesis for equities down below. If we look at what's going on with gold, we haven't checked in on the yellow metal in quite some time. It's sort of just digesting a majority of this big breakout that it experienced earlier on in the year. I don't look at this chart and, I wouldn't carry this too much over into the analysis at this point, considering it's more so stable inside of a range. If we look at the TNX interest rate, this is where we've got to start having some conversations, right? Because we did just break down underneath the 43.33 on the TNX, 4.33 on the 10-year. We broke back down underneath it today after another consecutive lower high here. So if you're bearish on interest rates, you would technically be bullish on bonds. We were just talking about that sort of relative outperformance on a TLT. What you don't want to see is like a rapid pace cut here. Of course, what that would signify is that the Fed is aggressively responding to perhaps really elevated unemployment. So as of right now, a slow and stable drift to the downside is ideally what you want if you're looking for continued bullish pressure out of equity markets down below. So far, so good. This is not like we've fallen off of a cliff, but I do want to point out once again that we're coming into or breaking down underneath 43.33 after a daily lower high. That is bullish for equities down below. Let's take a look at the inverted ZT and see what's going on with our interest rate. It's really the inverted ZT is the 2-year bond, right? So moving lower should imply that the Fed is perhaps getting ready to cut rates. Let's take a look at the tracker tool and see how this whole story really plays out. So I actually find it incredibly interesting that the tracker tool is telling us that the market is calling Jerome Powell's bluff. The updated SCP, which we'll look at in just a moment, only outlines one 25 basis point rate cut into the end of this year. But the Fed tracker tool is saying, nope, you're going to give us 1 and you're going to give us 2 in the December timeframe meeting. Now, if we look at the SEP, why can I make that determination? I mean, look right here. Instead of the projection from March, which was 4.6, that's arguing for 3 rate cuts. Now we're at 5.1 as the median sort of projection in 2024. I also found it, and again, this is why I dubbed the report as basically useless in the intro, that Jerome Powell and committee had sort of argued that the median projection for core PCE would be coming in at 2.8%, And that's exactly what the PCE inflation rate is already. Now, he did acknowledge that there are some basing effects that are likely going to take place. A couple of fairly low reads are going to be dropping out, being replaced with slightly higher reads. I get it. It's possibly a hedge to their bets, but I mean, that's useless information. We sort of know that's already where we're at. So he's basically telling us, if he's a man of his word and that's truly what he believes, there's going to be no more progress on inflation for the remaining 6 months of 2024. That's obviously much more hawkish than it is anything else, and sort of justifies the higher for longer stance here out of the Fed funds rate. The other interesting thing is that the unemployment rate was basically untouched. So Jerome Powell and crew is basically saying, no, we're going to navigate the soft landing. You better believe it. We're going to keep rates higher for longer in the labor market. It's not going to break at all. What I do find interesting is that the subtle projections as we move forward into 2025 and 2026, even longer run, is a little bit of a higher expectation on unemployment there. So a 4.2. Jerome Powell is really telegraphing to us, hey, we're not going to budge on a rate cut if the unemployment rate is 4.2. Like, that's totally within the bounds of what we forecasted so far. So as we move into, I know we just got it last Friday, the full labor report, but this upcoming month's report, if we get a 4.2, don't expect Jerome Powell to really do anything aggressive and change policy stance in the blink of an eye. As we move lower through this report, I do want to point out a couple of other noteworthy things. This is the dot plot, if you ever hear that term. This is ultimately what people are referring to. And what it shows is the median projections of participants, right? So wherever they think rates should be for 2024, they put their little dot. And you can see that this is really clustered all around the same area, indicating higher for longer. So everybody's on board with higher for longer. Notice, and this was different to our previous SEP, there was some pretty big outliers to the upside, which were indicating a rate hike. Nobody is in favor of a rate hike in the Fed at this point in time, which I would argue, anybody who was saying that prior was really just taking a political stance. That's my take. Maybe a little bit off the cuff for me. But anyways, the next and sort of last thing I want to point out is the risks and balance to the Fed's dual mandate. As we scroll down here, there's GDP, and here is the unemployment rate. So the Fed sort of takes a measure. Are we concerned about the risks to unemployment relative to the second part of our dual mandate, which is PCE, price stability, right? So right now, they're seeing it as broadly balanced. The unemployment rate is okay, right? We're sort of in this limbo right now where we don't have to react to one side or the other, right? If we move down and sort of check in on the risks to core PCE, we'll use the core read down here. They're still seeing that inflation is a bit more of a risk compared to what we have out of the labor market, right? So again, going back to that point, if you see the unemployment rate tick in the upward direction, I would not encourage you to start standing from the rooftops and shouting and saying, hey, the Fed's going to cut rates, they're going to cut rates. They're basically telling us in this report, nope, we're not going to do it. So, Matt, why were you talking about 4,800 in the intro? Why is this all so interesting? Well, because if you recall, and maybe you do, maybe you don't, but the last time we had a 5.1 federal funds rate target based on the SEP was actually in September of 2023. Here is September of 2023, looking at the forward 12-month PE ratio. That's this red intersection right here. Let's just round off and say that 18.5 is our forward 12-month PE ratio. If you look at the EPS projections, the forward 12-month EPS projections right now for the S&P, they're at 260. So you do the math and you tell me, that brings us closer to 48.10. Obviously, the PE ratio currently is way closer to 21. So again, the argument here is not to say that this math equates perfectly to 4,800. Let's just use it as a directional vector. Obviously, there's been more improvement on inflation. We're later on in the cycle compared to 2023. So again, it's not an apples to apples comparison, but just as a general vector dynamic, this would point at downside. Right? Jerome Powell's stance today was very, very hawkish relative to previous information that we've gotten. So here is what we had on today's session in terms of the actual reports. You can see that the actuals beat right across the board. These are the priors, obviously, and your next column over here is the consensus, beats across the board. So where did those beats come from is the next really important thing to dive into. Here's the actual CPI report. What I want to point out to you is that if we look at energy was down big time for the month of May, down 2 percentage points there, month over month. Huge deflation out of energy. And if that's going to continue, then great. But if it's not going to continue, if we start seeing, let's say that June is really more so flat, you could get something like a negative, 0.1 or something like that. Maybe if there's a little bit of trickle over effect from that CL chart moving aggressively to the downside. what's the next biggest sort of component here? I mean, let's take a look at shelter. Housing prices and just basically owner's equivalent rent prices as a whole, they're still trending basically flat at a 0.4. So are you going to continue to see inflation persistently move to the downside? I'm not sold on the idea, especially if we can spot a reversal on the CL, crude oil chart. I don't think that all the pieces of the puzzle are there. So I was really hoping for a little bit more out of Jerome Powell during today's meeting, but based on all of the things, all of the mechanics I can see, if energy deflation dries up and if we don't see any continued progress or any progress at all, notice that these are all 0.4s out of the shelter side of inflation. I mean, sticky services are just going to continue to haunt us, and any premature cuts, if they're trying to follow in the footsteps of the ECB, the CCB, totally a policy mistake from Jerome Powell. I hope that it's higher for longer. I hope he can acknowledge when the time is appropriate based on how the CPI and the prints are coming in. But I don't really think he gave us any big insights on today's session. So with that, let's get back on over to the platform. Let's finish up our job here. I am going to bring back into the mix the TLT ratio to the S&P because of what we were talking about just a moment ago and the outperformance here. If this is going to start to bottom out, it's at least worth keeping an eye on. So we've got equal lows. It's all about, do we produce a higher high now out of that? And that would be slightly a risk-off indication, small flight to safety. But if we look at bonds in relationship to themselves, lower highs have ultimately held. So I am constructive out of this. This is a risk-on indication in terms of duration and risk appetite from a time frame perspective. Let's move along to the high-yield junk. Oops, sorry, we skipped credit spreads. We'll get to that in just a second. But high-yield junk did end up breaking to a higher high. It's technically a higher high from here as well. Still not really performing to the magnitude that we'd like to say. Everything's fine and dandy in terms of divergence or convergence with the S&P. So small issues out of this as we look at the HYG in isolation. Let's go back over to credit spreads, though, because on today's session, it's worth looking at everything as the market digests new information. Credit spreads moved lower out of the short term, which is really what we care most about in the short term. The medium term is really just more so stable. It's not like it ticked higher. It actually ticked lower on today's session. Let's move along to the Bitcoin chart. Stable inside of the balance range here. Nothing to report on Bitcoin yet. New highs versus lows. We want a daily time frame chart here. As we were gapping up to new all-time highs, new highs versus lows. Also a higher high in this overall sequence here. So I'm liking what I'm seeing out of breadth, but if we're thinking about the IWM, it's not really all charts. I would say that a lot of this has to do with just the tech concentration over in this side of the market. Let's move along to, we don't need the SPXA 200R, but the 50R will do. So again, as we're thinking about this and breadth as a whole, a more holistic picture, still underneath the 50% mark. That's not ideal as the market's breaking to new all-time highs aggressively. RSP is obviously still divergent from this perspective. I would be more concerned when and if we drop the 163.63 level, just as we described on Saturday. QQQE also divergent. No big surprises over here. More concerned about this one, not when we drop this level on the chart at 87.10, more so this level here at 86 flat. So watch that in your QQQE. And we'll move along to the Dow Industrials versus Transports. The consolidation and sort of acceptance below the bottom of this range is another bearish divergence. So breadth-wise, it's really just the mega cap tech that continues to push your S&Ps in the upward direction. You're not seeing huge participation outside of those particular sectors/indexes. If we take a look at the VIX volatility down towards these lows, no issues out of the VIX. The VVIX, though, interesting lower wick. I haven't seen something like this in a very long time. As Jerome Powell is announcing, or the SEP is basically released, the VVIX absolutely spikes to the downside below 75. So complacency effect is in force. If there is any sort of pullback to close the gap, I could easily see this spiking. It's all about how high does it go. If the VVIX is underneath this pivot high, if it's underneath 90, we'll just say for round numbers sake, small uptick here is not enough to run, duck, and cover and sort of start to say, okay, the sky is falling from above us. Let's move along to the volatility futures to finish it up. Strong contango, closing underneath the 1275. Out of the one-day VIX, most of the volatility indications would point to bullish activity in my perspective. All right, let's dive into the core list of companies, kicking things off with Microsoft. What do we see out of the daily time frame chart? Certainly a breakout to new all-time highs. Big solid move off of these lows. Very, very straightforward daily time frame chart. Any pullbacks that go for a move to retest the top of the range over 432 are bullish, looking for a higher low. The upside into blue sky territories really takes care of itself. No need to overcomplicate this chart. On the hourly time frame, you'll start to notice some larger upper wicks here into the afternoon. There's probably a breakdown point, I would argue, somewhere in this area at 437.80. If you're consolidating above, I would not try to short this beast, and I would look for follow through in the upward direction. If you break for a lower high underneath, you could get the thin structure retracement retracement into that daily higher low that we were just describing here at 432. Moving along to Apple, again, this chart is just absolutely on fire. Huge, massive 10% move in the upward direction. No need to overcomplicate it. Let's keep it simple. So going down to the hourly, there's really thin structure all around us. If there's any sort of recovery effort over 215, call it for what it is, bull flag consolidation. Just let it be. Maybe there are some longs on breaks and higher lows over the previous high of day. Just make sure you can manage your risk into blue sky territories. If we're underneath 215 and we get some sort of rally to begin the day, if we reject that 215, you could look for a tight risk short here. Now, you'd have to spot the intraday setup. You're not just blindly shorting this at 215, but if you can spot the setup, and if the risk reward can be pulled off for something like this, it's totally a thin structure retracement all the way back down to this consolidation from the Tuesday session at 205.50 down to about 203.75. So I don't know that I would try to step in front of a moving freight train. I don't know that I would tug on Superman's cape, but that's possibly an idea just in terms of something to do if you're looking for that, if that's your trading style, not mine, into the end of the week. So those are your key levels out of Apple. Outside of that, it looks like the Apple AI thing actually landed with investors on this huge move to the upside. Personally, I think that, I've got my own thoughts about that. It's probably actually inappropriate to bring up in the video in terms of what I think, because who cares what I think? The stock did what it did, right? NVIDIA's got this really odd upper wick. I'm not too fond of that. So let's go to an hourly time frame chart. Obviously, that's not supposed to be there. We'll fix that in hindsight tomorrow. But looking at the chart in front of us, we did go for a gap fill reversal early on in the session today and printed a brand new all-time high. So you've got to be bullish here. Hourly higher lows over 122.50 look great for a break, retest higher low, looking at your equal high, and then blue sky territories beyond that. The only short I can see here out of NVIDIA is underneath 118.25. If we were to break down underneath that, perhaps something towards this 115.25, it gets interesting for like a weekly pullback higher low there. At that point, though, I would start to think about, okay, what's the risk for this to act as complete overhead supply? So watching NVIDIA primarily for this idea into the end of the week. Anything that does this is also technically tradable. Just make sure that, again, you have some place to be able to manage your risk. Let's take a look at Google. What's going on with the Goog? And again, we're still on an hourly chart. Any weird wicks out of Google on the daily? No, they're not. So new all-time high, but a big lack of acceptance up here. Notice that Google has really been lackluster in this range. It's not been trending really cleanly in the upward direction. I suppose if this is a double bottom, great higher low happening above, but the break through the equal high was not really well received from the market. So on the hourly chart, it's like we're almost getting a little bit too level happy in here, but I think that we've got to have at least some of these reference points as we move forward. So consolidation here, I do like, because if we highlight that, you're staying over this shelf of previous resistance in here, resistance in here. It looks like constructive consolidation. So if you could pull off the long over 176.75, that's one place to enter long, or something that looks like this. It's just a big upper wick there in the first hourly bar of today's session, some sort of higher low there. At least you could set up the risk reward to target the all-time high for something that looks like that. So that's really my primary goal out of Google into the end of this week. I don't know that I would be aggressively bearish, even if it were to drift underneath some of these levels. Just looking at the lack of trend in this box, I think it's more of a pass. It's either going to clearly show me the long and will participate, or in here, I think it leaves a bit to be desired in terms of the setup. Amazon, what do we see out of Nancy? Getting a little bit grindy in the upward direction. You could certainly make the argument that you've got yourself a trend channel in the upward direction. We're sort of in the midpoint of that channel. So, straightforward would just be higher low acceptance over 187.25, trading into 189.25 for the full rotation on that one. If we are just consolidating here, I would be open to this idea as a possible, let's not get too crazy, but maybe it's some sort of like sick and twisted Man Ray pattern, perhaps, underneath 186 with a lower high. Target would be back down here for the major retest on the daily of 183.75, the top end of this prior balance range. So take it at face value. Any consolidation, it's this for upside, and it's this for downside into those two levels. Let's move along to the metaverse. This one's looking great on a daily time frame chart. You've got to acknowledge just the strength of the stock to recover after this earnings gap down. It wasted no time, just total consolidation, breaking and continuing in the upward direction. I think on the daily time frame chart, we did start to see a bit of an exhaustion gap up this morning. We closed fairly low in the overall daily range. So a couple of things come to mind on the daily. If we're looking for a pullback, your pullback higher low is at this zone. So it leaves a little bit of room to the downside for that, higher low to persist, right? You have lows, higher lows, higher lows. You could easily continue the daily uptrend over the daily 50 SMA, the blue moving average on your screen. If we take it on down to the hourly time frame chart, how might we achieve something that looks like that? a couple of things come to mind. But first of all, this starts to set up your right shoulder. If you could short the right shoulder into the neckline, that's a good first step. Ballooning that into something that comes down here also makes decent sense. Now, if you never get under that right shoulder area, if you never take out 501.25, then guess what? There's no short, there's no daily pullback. It's just consolidation over this multi-day balance, which broke in the upward direction, and now you're getting a reasonable hourly higher low, lows, higher lows, higher lows, and there's no need to fight the trend, right? It would just be this back in the upward direction. Or if you can pick it off, you can find the 15-minute bullish setup, 5-minute bullish setup, hourly hammer candle down here at 501.25. Guess what? Trading right back in the upward direction. Tight risk here, something that looks like this, aiming for that equal high. Let's take a look at Tesla. Finally, this thing's such a maddening stock, let me tell you. You guys know that we've been watching for a while. This balance range finally got the acceleration underneath, and there was a great scalping opportunity. I'm going to drop it down to a 5-minute time frame chart. Look at the bearish 3-bar play that sets up here for the follow through, right? So beautiful trade there on the Tuesday morning session. However, this morning, I can speak for myself, I'm not going to speak for you, but optimistically, this is a lower high to keep all of this as overhead supply, right? And, there was certainly some relative weakness out of Tesla off the open. It was not gapping up with CPI. So to see it weak underneath the overhead supply, I was looking for the lower high here. Obviously, there's no follow through underneath that 173.50. So sort of back into reevaluation mode out of Tesla inside of this range leaves a bit to be desired. As we know, over 180, show me the hourly higher low, not the 5-minute, not the 15-minute. Show me the hourly higher low over 180, and even better is the clearance of 185.75 for a stronger squeeze range to be looking for up into 198.85. So one step at a time. I would call this a pretty big failure from the sellers, so probably leaning a little bit more so on the bull side, but again, prove it to me first before I'm going to throw money at that setup. Next up, JP Morgan. What do we see on the daily time frame chart? A little bit of a rounded top here, certainly breaking down from this. This is kind of that rounded top activity I was referring to. Really aggressive sell side days, and is this surprising considering what we were just describing earlier out of the XLF, whereas there it is down in the watch list? Not really. The weakness out of JP Morgan is somewhat astounding. You've got this previous pivot high, which is not acting as support. 50 SMA is not acting as support. So I don't think you want to be the sucker short, dead on the lows of the overall move, but lower highs in here on the daily certainly make a lot of sense. Even this on the daily time frame chart, rejecting the overhead supply at 196.35 also makes decent sense. Here we are on the hourly time frame chart. Look at the real weak consolidation into the afternoon breakdown. Nothing about this chart is screaming, hey, it's time to go long. I would not think of this as a pullback long opportunity. You're actually drifting into a daily downtrend with highs, lows, and now lower lows. So you're really just trying to scout the next daily lower high, something that looks like this for continuation in the downward direction. Next up, Netflix. What do we see? Daily trend, a little bit lackluster. Hourly trend, trying to navigate the head and shoulders, right? We've been talking about this for a little while now. The right shoulder's getting a little bit convoluted. Perhaps this just ends up being a double top. But as of right now, I think that this is kind of no man's land in here. The ideal consolidation from today's session would have been a gap fill reversal to keep price here, and then this would have been the long. Obviously, that did not play. So the lower high underneath has me feeling a little bit more so on the short side, double top rejection. And if we can get any acceptance underneath the 644, I would tend to think that this rotation can take place into 634.65. So leaning a little bit more so on the short side out of Netflix. Daily trend is somewhat neutral. We're sort of in the midpoint of the balance range, if you will. I think you really want to be precise near a key level. That way you can tighten up the risk and not just be sort of stabbing around in the dark there and trying to make something out of nothing. The daily trend, it's not easy to take advantage of at this point. Next up, last but not least, before 2.5 additional trade ideas for you, we've got AMD. AMDizzle is very similar to Tesla. However, it did not recover on a straight shot higher into the overhead range. So this is the ideal sort of structure, right, where the overhead supply is now acting as a lower high resistance. If you caught it there today, great. The next setup is ultimately through the equal lows for thin structure retracement into 153.25. So leaning more so on the short side out of AMD. The only time where I would change my tone is if we get the brigade bolt up and over the neckline of what could be considered some sort of double bottom. So this higher low is what's required before we start thinking about longs for some sort of, we've already seen look below and fail once, twice, 3 times. Is it going to be a fourth? We'll see. But again, show me the proof over 162.75. 2 trade ideas for you. First one, MA, MasterCard, financial sector, right? No longer in the tech sector, so financials. What do we see? Nasty bearish engulfer. This did participate in the gap up on this morning session over the previous day's high, closed underneath the previous day's low. So what I'm looking for is to see whether or not this kind of idea in here is going to play as a descending triangle. You're definitely in a daily downtrend with these consecutive lower highs, looking for an equal low break, of something like 440 to the downside. Probably needs some refinement out of the chart, but generally speaking, this is going to start going on my radar. This is a very classic, flush point, lower high, equal low, looking for that move to the downside. Targets off to our left. This breakout point certainly becomes top of mind at loosely 426. So that's your downside out of MasterCard. The reason I said 2.5 trade ideas is because Visa is going to fall into a very similar category. There's your breakdown area, and here is the level. So a little bit cheaper of a price point. Not much, but still great in terms of options trades on both of these names, MasterCard and Visa. Same setup, right? It's identical, so I'll call this half in terms of trade count there. So bearish engulfer opens over the high, closes under the low. If you can sweep these equal lows, looking for a breakdown 200 SMA, and breakout point from here is certainly interesting as a possible target. If it goes beyond that, then great, but initial indications are just that the bears are really showing up and flexing that muscle, saying, hey, look at us, look at these lower highs, look at this big bearish engulfer, look at these equal lows. If they break, I'm starting to think about downside, right? So that's MA and V. Then the next one is Dash. See what's going on with DoorDash. So this is another name. There weren't a ton of great trade setups, to be quite honest with you. It's not fully formed yet, but maybe you can see where I'm going here with this one. Maybe inverted head and shoulders. I like the gap fill reversal, so relative strength compared to the financial sector that we were just looking at for sure. Maybe this could even be considered like a very micro head and shoulders to form the head of the overall pattern, and I like the fact that we closed over that. I'm also really drawn to the fact that these are really mechanical flat highs right across the top at 117.75. It's also an earnings gap to close overhead. So if we can clear that over time, if we can build out a right shoulder, let's bring in a level here. I would watch for 113. Let's just make that a round number. I know that the MasterCard and Visa trade did not have refined levels. They were not round numbers only for the penthouse rule number 2, but it'll suffice. So anything that's in here keeps the setup in force, looking for this to close the gap, and your target is going to be up here at this low. Let's call that 127 for round number's sake, and that is going to conclude today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new tonight, let me know down below in the comments section or by giving the video a very simple thumbs up. Hopefully you enjoyed the coffee and donuts up in the penthouse suites this morning for CPI. Tomorrow we have PPI, so keep your eyes peeled for that. We'll be live at 8 o'clock, as we typically are, right here on the channel. Come join us. If you're new, say hello early in the chat, and we'll give you a big shout out in the morning stream. So that is going to do it. I wish you all a green trading week, and I will see you in the next one.